The broadcast is now starting. All attendees are in listen-only mode.
Hi there. Hopefully everyone can hear me. Thank you for your patience on that. My name is Heather Roschek, and I'm the Education and Marketing Manager for Countryside Conservancy. We are a nonprofit based in Peninsula, Ohio that manages the Countryside Initiative program, which has seen 11 working family farms reestablished in Cuyahoga Valley National Park. We also provide educational opportunities for farmers of all levels of experience, as well as for backyard gardeners and home cooks. And finally, we manage 3 thriving farmers markets year-round in the Akron, Ohio area. So again, thank you all for joining us for Taxes for Farmers 101. This workshop is funded through a grant from the ODA, the State of Ohio, and the USDA under the provisions of the Specialty Crop Block Grant. I'd now like to introduce you to our speaker for today, Marianne Berger, the CEO of the Number Manager, Inc. in Cuyahoga Falls. Marianne has been in business providing tax and accounting services for 26 years and has been a CPA for 18 years. The Number Manager, Inc.'s expertise covers a wide range of services, providing quality, personalized financial guidance to local individuals and businesses. So I'm going to get ready to hand this over to Marianne. She is planning to present for a little over an hour, and then we'll have time for some additional questions at the end. However, on the right side of your screen in your webinar controls, you should see a box there to type in any questions. Please feel free to type those in as we go along, and we will either answer them as we go or save them for the end there. So I'm going to go ahead and send this over to Marianne so that you can see what's on her screen here, and hopefully we've got everything working for you. And Marianne, are you there?
Yes, I am.
Perfect, and we've got it all up on our screens here, so you're all set to go.
Okay, and are you, all of you, seeing my full screen now? Taxes for Farmers 101. I'm Marianne Berger, CPA of the Number Manager, Inc. Thank you for joining us today. This is my first webinar, so you'll have to forgive me. I'm a newbie at this. But we'll start with some objectives for the class today, and that's reinforcing good record-keeping and bookkeeping practices. Obviously, if you're not keeping good records and doing your bookkeeping and accounting, you can't prepare and file your income taxes. You cannot manage your business properly. This will be a basic understanding of forms most often used in the agricultural industry, a basic understanding of definitions pertaining to farm income and expenses, a basic understanding of taxation concepts, and that's kind of funny, basic understanding still is very complex, as you guys will see today. There are several guides available that are very helpful for the farmers. One is Publication 225, Farmers Tax Guide, and you can find that at irs.gov. Go to Forms and Publications and go to 225. It is a very sizable guide, so you may want to download it and review rather than print it. I think it's something ridiculous like 100 pages, 150 pages. Publication 51, Agricultural Employers Tax Guide. Again, when you have employees and you're in agriculture, this is a good guideline, again, through irs.gov. Tax Guide for Owners and Operators of Small and Medium-Sized Farms is also a very good guide. And it's located at www.ruraltax.org. Also a very sizable guide with very good examples. The farming tax forms that are commonly used, Schedule F, obviously, profit and loss for farming, 4562, depreciation and amortization, Schedule SE for self-employment tax, 4797, sales of business property, 4136, credit for federal tax paid on fuels, 8903, domestic production activities deduction, Schedule D, capital gains and losses, and Schedule J, income averaging for farmers and fishermen. These are very common forms used in the farming business. Other forms that can be used, 4684, casualty and theft gain or loss, 4835, farm rental income expenses, 8824, like-kind exchanges, and 3800, general business credits. The Schedule F, profit or loss, you do not use a Schedule F for agricultural service such as soil preparation, veterinary services, farm labor services, horticulture, or management for a fee on a contract basis. You will use a Schedule C for those services, not F. So there may be farmers that do some of these services as well, and you would be filing a Schedule F and a Schedule C. The Schedule F is also not used for the sales of livestock held for draft, breeding, sport, or dairy purposes. You would use Form 4797, sales of business property. I know that this is a common error when farmers are preparing their own tax returns, and it ends up costing the farmer more money in tax if the appropriate form is not used. On the Schedule F, if everyone would like to get a Schedule F, I do believe that we did provide some copies of some of the forms so you could refer to them today, so that you know what line items and information that I'm talking about. On the Schedule F, profit or loss for farming, the name of the proprietor and the Social Security number goes at the top of the form. The principal crop or activity use is the same as the code, crop or animal production, forestry, or logging, and that code comes from page 2 of Schedule F towards the bottom to identify what kind of farming that you are doing. You need to enter whether you are utilizing a cash or accrual method. Those methods are determined many times by the type of farming that you're doing. Most farmers are cash basis. However, there are some types of farming that are required to use the accrual method. Enter your EIN number if you have one. Most of the time, farmers, sole proprietors do not have an employee identification number unless they have employees. So you would just put your Social Security number on the form, and you would not be required to fill in the EIN. Did you materially participate? I'm going to cover that coming up here, but material participation for a farmer is very important, especially when farmers have losses and the deductibility of those losses. did you make any payments in 2012, and file a 1099. There are requirements for individual or when you purchase goods or services and pay $600 or more, and that person or company is not incorporated, you have to issue 1099s. And question, if yes, did you file them? The government is now cross-matching these items to make sure that people that you are paying are claiming that income. Material participation and rental income. I think that this needs some clarification too. There are a lot of farmers that do both. They rent part of their farmland, and of course the material participation rules go with the farming income as well. Rent received for the use of real estate is not subject to self-employment tax and generally not reported on Schedule F, but on Schedule E. I do think that there are a lot of farmers that do report the rental of their land on the Schedule F and therefore are paying unnecessary tax because of it. Rent received for land used in agricultural production is subject to self-employment tax if the owner materially participates in the farm operation. This is reported on Schedule F, line 8. Again, that material participation. Net rental income subject to self-employment tax is for land use, not the rent of buildings or equipment. Rental of the buildings and equipment are reported on Schedule C. A landowner materially participates in a farming activity if he or she meets one of the 4 tests. And test 1, the landowner performs any 3 of the following activities. Advances, pays, or stands good for at least half the direct cost of producing the commodities. Furnishes at least half of the tools, equipment, and livestock used in producing the commodities. Advises and consults with the tenant periodically and inspects the production activities periodically. That's test number 1. 3 of those 4. And then, of course, 1 out of the total 4 tests. Test number 2, the landowner regularly and frequently makes or takes an important part in making management decisions substantially contributing to or affecting the success of the enterprise. Test 3, the landowner works hours, 100 hours, that should say, or more over a period of 5 weeks. So that is 100 hours or more over a period of 5 weeks in activities connected with producing the farm commodities. Test 4, the landowner takes actions that, considered in their total effect, show that he or she is materially and significantly involved in the production of the farm commodities. If the landowner does not materially participate in the farming activity, the tax reporting depends on the form in which rental payments are received. Cash rental payments are reported on Schedule E. Crop share arrangements are reported on Form 4835, Farm Rental Income and Expense. Tax planning opportunities exist where the taxpayer farmer operates the farm, but the spouse owns the real estate. It is a very good method for mitigating some of the self-employment tax. And now we'll go back to the Schedule F and Part 1, farm income. And you can follow down the form. There is a line that has for sales and cost of livestock, sales of products that you have raised, taxable distributions received for from cooperatives, which were reported to you on a 1099 PATR, and also notice on the form the gross amount is reported and the taxable amount. Well, why would they put that on the form? Well, obviously there are exceptions to what is taxable and what isn't concerning these types of payments. The 1099 PATR from cooperatives, the agricultural program payments, 1099-G, which is more commonly received by the farmers. Custom hire income is another form or another reporting that goes on the income for cash method. Crop insurance proceeds would be reported to you on a 1099 miscellaneous in box 10. And then other income, land rent, as we had just discussed in the material participation rules. If you were materially participating in the farming of the land, and the land rent would be reported here under other income. I'm going to skip to part 3 because this is farm income accrual method. And this would be an accrual method recording expenses as they're incurred, income, not when it's received, but when it is generated. And also for plants with a pre-production period of 2 years or more, or animals unless you're electing out. Specified sales of livestock, produce, grain, income from ag programs, crop insurance, etc., just like on your cash basis part of the form. But on this part, you have inventory. You must report your beginning and ending inventory on the items that you are producing or in the raising of livestock. And you would have to record your expenses and income and your inventory, and you are required to do a physical inventory and keep very strict inventory records on crops, animals, so forth. Another part of Part 3 is this uniform capitalization rules, which it can be very confusing. You must include direct and indirect costs in the basis in the property you produce or in your inventory costs. You recover these costs through depreciation, amortization, or cost of goods sold when you use, sell, or otherwise dispose of the property. Again, this is the accrual method. In the farming business, you produce property if you raise or grow any agricultural or horticultural commodity, including plants and animals. The exceptions, of course, there's an exception, any animal. On the prior screen it said animal, and now it says any animal is the exception. Again, tax law is not always very clear. Any plant with a pre-production period of 2 years or less, any costs of replanting certain plants lost or damaged due to casualty. These are some examples of plants with a pre-productive time frame of greater than 2 years. And you can see that, you know, you've got your nut trees on here, and you've got a lot of your citrus, coffee beans, apples. Well, what does that mean? That means that you just cannot take the cost of producing these items in year number 1. You know, you don't have a yield yet. And you cannot just take the cost of the trees, the cost to maintain the trees, and so forth. You can't just write that off each year. You have to accumulate the cost and write it off as you produce yield. Direct and indirect costs, again, preparatory costs purchases of seed, seedling, plants or animals. Pre-production costs are also plants, irrigation, pruning, frost protection, spraying, and harvesting. Animal feed, maintaining pasture or pen areas, breeding, vet, and bedding. An example, you grow blueberries that produce an annual crop. You are an individual and the UNICAP rules apply. You must capitalize direct costs and allocate indirect costs incurred due to the production of the blueberries. What does that mean? Year number one of a blueberry farm, when you're purchasing all your plants and you're readying the soil and so forth, so that perhaps in year 2 or 3 you can produce a crop. You cannot just take the cost of those blueberry bushes and the cost to prepare the ground. You cannot just write that off as a total expense in year number one. You have to allocate that over a period of time, and I know that a lot of farmers are not following this for the type of farming that they're doing. I know that the IRS isn't real strict about these rules as of now, but we don't know what they're going to do in the future. I want to go then back to part 2 on the Schedule F and talk about farm expenses. Some of the lines on this, on these expenses are self-explanatory and others aren't. Line 10, car and truck expenses, form 4562. You can use an actual expense or a mileage method on a farm truck or another personal vehicle. You need to track mileage for any vehicle that you use for the farm. You can also track, or you need to track, all the costs related to those vehicles. Gasoline, repairs, insurance, license plates, interest if you have it financed. And you need to keep good records. You have a choice. You can take the mileage rate for the business use miles, which you can see in 2012 is 55.5 cents a mile, in 2003 56.5 cents a mile, or you can use the percent of use method. I have my clients track both so that I can take the biggest deduction for them. Lines 11, 13, 15, 16, 17, 18, 19, 20, 23, 24, 25, 26, 27, 28, and 31 pretty much are self-explanatory on the farm form, and they're exactly what they say they are. That's what can be deducted on that form, F. And I really don't find that it's necessary to go into any other explanation on those lines. The lines that I've not included on there, we're going to cover. Line 12, conservation expense must be consistent with a conservation plan approved by Natural Resources Conservation Service. The costs include treatment or movement of earth, diversion channels, ditches, earthen dams, eradication of brush, planting of windbreaks. That is fully deductible, up to 50% of your net income. Line 14, depreciation in Section 179 expense. Again, you would use the 4562 to calculate, and this is to capitalize your assets that are used in farming. The cost of any item that is used in your farming can be depreciated over what the IRS has determined its useful life. Those useful life charts are published and you would go by the type of asset that you have purchased. For instance, farm machinery and equipment, you would depreciate it over 7 years. A farm building, 20 years. Dairy cattle, 5. Horticultural structures, 10. Trees or vines bearing fruit, 10. There are many different methods of depreciation that can be used, and software, tax preparation software is the best method to use to calculate. It can be very daunting to try and calculate these items by hand, and there are many elections that can be used. The Section 179 part of the depreciation is what most of the farmers use. They don't want to depreciate, they just want to write it off, and they can. They can write it off as long as it doesn't exceed $500,000. The Section 179 expense does not have to be a new asset. You can also take a deduction. Many of the farmers can take the deduction when they first go into business and they're transferring personal use assets into farm use assets. And I also know that this is a deduction that is often missed. I deal with a lot of small farms and startup farms, and many farmers already have tools or have some type of equipment that they use on the farm. Those can be converted to business use and a deduction taken, which can help the tax situation of the taxpayer, and especially a new farmer that still has a job or spouse has a job, because this can offset W-2 income. You can not take a Section 179 if it produces a net loss, and again, if you do not have other W-2 income to offset. If you just have farm income or loss and no other income on the return, then you are limited on that net loss and are available to either carry it back or carry it forward under those rules. If you sell or dispose of one of the assets that you have elected to expense, if you do it within 5 years, you have to recapture that depreciation at ordinary income tax. So when you write it off, it offsets ordinary income tax rate. And when you sell it within that 5 years, you would recapture it. They would add it back into the income. There's some good tax planning that can be done with regards to the disposal of assets. There's also a provision that really had ended in 2012 for the 2012 tax year, and it was a special depreciation and bonus depreciation, and that was only on a new asset. And you could take it even if it was producing a net loss, and also you did not have the same recapture provisions as the Section 179, so it was a valuable deduction. We don't know if they're going to bring that back or not, but it has been around a while, and also to any of you that may have been able to benefit from taking that bonus depreciation, you still can amend the returns and take that. Line 22, labor hired. Again, this is on Schedule F, Part 2, line 22. Employees, $150 per individual or $2,500 test total of all farm work. That's what the IRS is using for their criteria, who is casual labor and who's going to become an employee. They are doing a lot of enforcement in this area with regular small business And I know that a lot of the farmers are just putting casual labor. They're not hiring people as an employee and paying the matching taxes. The unemployment, farmers in the state of Ohio are not subject to unemployment. They're not subject to federal unemployment tax, and they do not have to pay into a workers' comp for the owner of the farm. They do have to pay in for the employees. A seasonal farm worker is classified as a hand harvest laborer, paid piece rates, commutes daily from permanent home to the farm, and employed in agriculture for less than 13 weeks. So again, if that criteria meets the people that are working for you, then good, they're a seasonal farm worker, and then you can escape, you know, the classification of the employee and paying all the taxes. Line 21, again, Schedule F, line 21, under the expenses. Mortgage interest. The mortgage interest that's paid on the purchase of a farm, farmland, buildings. If you're living on the farm, you should be allocating this mortgage interest. The majority of the mortgage interest, if you allocate properly, will be on the Schedule F, which reduces your self-employment tax and also reduces your state of Ohio tax and any city tax if it's applicable. Line 29, taxes. Allocate the real estate tax for the farmland, buildings, and farmhouse. You may use any reasonable method. This is something that is missed also, as well as line 30, the utilities. Allocate according to the buildings and the farmhouse. You can use any reasonable method. When you have a large farm, any size farm really, you usually have a farmhouse and you have a barn where you have outbuildings and so forth. Even if you get one utility bill, one electric bill for the whole farm, it can be reasonably allocated so that part of that is deductible on the F, and you get the tax benefit for it. Otherwise, utilities aren't deductible. On normal 1040, there isn't any place to take utility deduction, and a farmer can, and I think it's missed. Line 33, if the farmer has a net loss, the loss can be limited. We had talked about material participation. If you don't materially participate in the farm, the hobby loss rules can apply. First of all, you don't material participate, the loss is suspended. You cannot offset other income from the farm loss. That is the reason that you want to definitely check the box, material participation at the top of the farm form, Schedule F. If you are a farmer, I mean, it's material participation. Therefore, none of the losses will be suspended. However, on the hobby loss rules, the government would like you to show a profit in 3 of the last 5 years. For breeding, showing, training, and or racing horses, it's 2 of the last 7. This is not really a hard and fast rule. There are many types of farming that can have losses for 5 years in a row and legitimate. You have to have a profit motive, obviously. But even look to trees, pine trees. some of their maturity rates are 7, 10, 12 years. So in the case of a tree farm, the hobby loss rules would be able to be defended. So again, it goes back to what type of farm you have, what type of product are you producing. Line 36, is all your investment at risk or some of it not at risk? Almost everyone I know that's in the farming business, their investment is at risk. You know, if you've invested in your farm and the farm doesn't make it, that your investment is at risk. You have personal financial risk. If line 33 is a net income, then you would complete the short Schedule SE, which is calculating the self-employment tax. And the farmers will use Section 8, the short Schedule SE. You don't have to do, it's a 2-page form. You don't have to do all the other things on that form. It's just the short Schedule SE. The tax is calculated, and over 15%, 15.65. The tax is posted as Form 1040, and then you also get a credit for 50% of the tax, and that goes on page 1 of the 1040 as an adjustment to income. It is not a difficult form to use for the farmers. The next form I want to talk about is the 4136. I think this is another form that is not being utilized by the farmers, and it is the non-taxable use of gasoline. It is a 4-page form with lots of calculations on it. However, the farmer only uses the very first section, which is non-taxable use of gasoline, and the line B, use on farm, the use on a farm for farming purposes. This is off-road use of gasoline. You would enter the number of gallons, multiply by 0.183, and that is the total credit on line D. And then you would enter it again on line 17 of page 4 of the 4136, and then it goes as a tax credit on line 70 of the Form 1040. This is a tax credit. It equals money. It is not a tax deduction, and can be worth quite a bit of money to the farmer. However, in order to do that, you have to track the number of gallons used for the year for the farm to calculate the credit. How are you going to do that? You should be marking your gasoline receipts when you purchase that gasoline, and mark right on the receipt what you're buying that gasoline for. You have to track it for your truck and your auto for your expenses related to them, and then also farm use. So here you would have the total gallons at the end of the year from those receipts to be able to calculate this credit. You can claim this as a credit against your income, or you can file Form 8849 to request a refund of that tax. When you receive a refund for the fuel tax credit, you need to report it as income in the year you receive it. So they give you the credit, but then you have to add it on as income the following year. The next form I want to cover is the 4797, and this is an important form. It is for the sales of business property. Part 1 is the assets that are held more than 1 year and taxed at capital gains rates. I've got 3 examples here. One, dairy cattle held over 24 months, and that is, by the way, the holding period for cattle and horses. All other assets are 1 year, but with the farmers raising cattle or horses, it's 24 months to get that capital gain tax rate, which is substantially lower than ordinary tax. I use the example too, timber there. If you have timber, and you've had that land and the timber on that land for more than a year, then 1 year would be for the timber. 24 months for the bull, 24 months for the dairy cattle. Part 2 is where you would record assets that you sold that you held less than a year. Those items are taxed as ordinary income tax at your ordinary income tax rate. The example would be a dairy, the dairy cattle used for breeding, but owned less than 24 months. Again, the 24 months is specifically for cattle and horses. Otherwise, less than 1 year. So you buy a tractor and you have it 10 months and you decide to sell it, well, that would be less than 1 year and would be reported here as a gain and loss, the difference between the cost and the selling price, and accumulated depreciation, and you would pay ordinary income tax rates on the sale. And there are ways to avoid that. There's tax planning to do on assets when you're going to dispose of assets. Part 3, which is on page 2 of the 4797, is where you would record the sale of assets used in the farm operation. The gain or loss depends on the holding period. Most farm assets are Section 1245 property. And you can see dairy cow used in milk production would be reported Part 3. And actually, on another comment on this 4797, I used the dairy cattle so you could see that a farmer could actually have to report in 3 different sections on this 4797. And none of these sales are subject to self-employment tax. So you want to make sure that when you sell business property, that it is reported correctly and on the correct form, because it can cost you unnecessary income tax. Form 4684, casualty and theft loss. Casualty is the damage, destruction, or loss of property from an identifiable event that is sudden, unexpected, or unusual. And examples: car, truck, or farm equipment, accidents, earthquakes, fires, floods, freezing, lightning, and storms. And I think we've had a lot of that in Ohio. So there may be opportunities for Ohio farmers to have taken a 4684 casualty loss on their tax return. The deduction has certain limitations, and I can't go in really to the calculations of those right now, but you can get a deduction for this casualty loss, insured or uninsured, when you go through the form and do the proper calculations. I just really want everybody to be aware of it so that you know to look into it if you have one of these incidences. Form 8903 is a domestic production activities deduction, and farmers automatically qualify for the deduction if they have W-2 wages. That means they have employees that they're paying W-2. They're withholding taxes from their pay and paying matching taxes. And it's a substantial deduction, credit. Now it's 9% of qualifying income not to exceed 50% of the W-2 wages. I had a small farm. I have a small farm in the practice, and his tax credit, he had $12,000 in wages that he paid his farm workers, and he received a $1,080 tax credit on his tax return. It is substantial. It does help the farmer when they are incurring W-2 costs. Schedule J, income averaging. I also believe that many farmers don't utilize the Schedule J. I know a lot of farmers do prepare their own tax returns, especially the small farms and the farmers starting out. Schedule J allows you to average your income over the previous 3 years. If there is a disparity in your tax bracket from those years, or if there is a very wide disparity in income, net loss over the 3-year period, it may be worth it to do the Schedule J, the income averaging. Again, various calculations have to be done, and most would want to use software to do so. And that is the end of my presentation, and I will take questions. I tried to speed up a little bit because of my time constraint, and I hope that we have questions that I can answer.
Yeah, thanks, Marianne. We do have one question here, so this is going back a little ways. But someone asked that if you do transfer personal assets to the farm business, can you talk a little bit about how to value those assets?
Sure. The rule is any personal asset that you have that you are going to convert to business use, whether it be a farm, whether it be another type of small business. In this instance, it would be a farm business. It is the lower of the cost or the fair market value on the date of conversion. So what would be the lower? It probably would be the fair market value on the date of conversion. If you have used tools or equipment, what would you do? You would determine fair market value. What is that? What would be a fair price that you would get for that? If you would to put it on Craigslist or advertise it in the newspaper or put it in a yard sale, what would be a fair price that people would pay for that item? And that's really what we list, what I list, and what I inform my clients to list. Be fair and reasonable about it. You know, look in the newspaper, see if some of those items are advertised. Use that as a guideline. Does that answer the question?
Hopefully so, and I'll let her pipe up if it doesn't.
Okay.
Right now, that is actually the only question that we have so far. Marianne, just in case there's anybody else who's still thinking of questions, please go ahead and type those in. But in the meantime, can you talk to us a little bit? We have another webinar with you coming up next month, which is a follow-up to this webinar, Taxes for Farmers 201. Can you give us a little bit of an indication of what you'll be covering in that webinar?
Actually, many of the same things, but more in depth. For instance, some of the tax payments that the farmers receive, they can be taxable or non-taxable. Some of the cooperative payments. Well, how is that determined? So it's going to go into more depth of the definitions of income and how to determine whether they're taxable. Many more tax planning tips, entity selection, whether a farmer wants to stay a sole proprietor or they want to elect to be a single member LLC, or husband and wife LLC partners, that will be covered. I know that presentation is going to be much longer than this one, and we'll give more examples, more planning.
Okay, great. Sounds good. Well, I haven't seen any other questions come up, so I am going to just take the screen back over here. We do have, as I mentioned, the Taxes for Farmers 201 class webinar coming up, and we also have a couple other ones. You can see their introduction to crowdfunding, which will talk through Kickstarter and some of the other popular crowdfunding websites out there, and then online ordering systems, which I know a lot of farmers have found really useful for adding to their business. This webinar and all of our webinars will be available on our website, which you can see there, cvcountryside.org. This one should be up by the end of the week. If you want to revisit it, especially closer to tax time, I'm sure that that could be helpful. And then also, I'm in the process of scheduling webinars for 2014. If you have ideas for webinars or any topics that you are especially interested in learning more about, my email address is right up there on the screen, so please do email me and we will see what I can do. And otherwise, you can visit our website to sign up for Mary Ann's follow-up webinar next month. And thank you all very much for attending. And this will end the webinar.